around measurement. The step 3 is determination of the transaction price. So an entity shall consider the terms of contract and its customary business practice to determine the transaction price. The consideration promised in a contract with the customer may include fixed amount, variable amount, or both. So this, determination of transaction price, which really looks simple, but in practical scenario, it's really a very complex area which sometime need to be evaluated as a professional in a way that because of the joint product selling in one product as a packet, we need to determine the transaction price in total. So on one hand, we need to, here in the third step, it is actually at the time of entering into any contract with any customer, we need to see what is the total transaction price. What is the total consideration which has been promised in a contract with the customer. It may be a fixed amount which we're going to charge to him, charge from the customer. It may be a variable amount also, and it may be both. I surely share an example with you about the variable, but before that, let's just see what actually include in determination of transaction price. So the very important note here is the nature, the timing and amount of consideration promised by customer actually affect the estimate of transaction price. So it is really the contract nature. It is the timing of when the customer gonna pay and then the entity gonna providing the goods and services, and also this amount which has been promised that actually affect the transaction price altogether. So let's build more understanding of this step 3, wherein to determine the transaction price, an entity shall consider the effect of all the following. They need to see what, if there is any variable consideration, is any constraint of the estimation of variable consideration, if there is an existence of any significant financing component in the contract, and this is like, if we are delaying the payment. So we have a normal credit period, and if we are extended that credit period, that leads to some financing component attached to it. Non-cash consideration also impact your transaction price, and the consideration payable to customer is also become a factor, or you can say is really affect your transaction price. So for an example to help you to understand this transaction price, guys, let's talk about, like, for example, an entity which is supplying laptop to large business holders, and they enter into a contract with any customer that they will sell $500 per unit. But when the customer approaches to them, they says, no, I'm going to purchase more than 500 laptops from you. So please offer me some discount. So then this seller or an entity asked him that, okay, in case you want to pay, if you are promising us to buy 500 laptops in a year, then we may reduce retrospectively this price to be $450 per unit. Now, for an entity, how we recognize this revenue? Either at 500 per unit or either at 450 per unit. So this really leads to a variable consideration component attached to it. There is a constant estimate of variable consideration. So for example, in first quarter, if this entity is following January to December. So in the first quarter, in the March, they see, okay, out of that 500, entity has not even purchased 50. So they have just purchased 30 laptops, and while doing that estimation, after looking at the purchase pattern in the first quarter, they feel like that it is not possible for this entity that they're going to purchase 500 in a year. So then they recognize that 30 laptops which has been sold so far has been delivered at the rate of 500 for the first quarter. So they recognize revenue of 30 laptops at the rate of 500. However, like for example, in the next quarter, they have observed that this entity has purchased around, they have reordered again, and they have purchase around 300 laptops. So then this is, the change in pattern give a conclusion that now they may exceed the threshold volume and they allow to give the discount, and then the revenue recognition will be done at 450. But in this, you need to do the adjustment of the price also. So what you want to do, therefore, you recognize the revenue for the quarter by calculating how many laptops has been sold now in total. So 250 laptop has been sold in total into 450, and whatever the earlier revenue you have recognized, so you need to reduce that amount, and balance need to be recognized this time. So this is the beauty of, I told you, the determination of transaction price, which is look like is just to knowing how much amount as a consideration the owner will receive. But in practical scenario, we really need to see the effect of all these points, which is reflecting on your screen right now. If there is a variable consideration, if there is a constraint estimating in it, if there is an existence of financing component, there could be non-cash consideration and consideration which is payable to customers. So it may be some time that some consideration we need to pay to the customer. We are receiving in exchange some services from the customer also. So it really depends upon the type of contract you have. Moving to the next step, which is like allocating the transaction price. So objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which entity expect to be entitled in exchange for transferring the promised goods or service to the customer. So this allocation, as we did the definition of standalone selling price also, and that is, used over here to see that, how much standalone price and how we allocate the total transaction price. So it says that the objective of this allocation of transaction price for an entity, so that they can evaluate that for each performance obligation, what is the amount which I should record in my books. So the key point here is the transaction price is allocated to all separate performance obligations, and that need to be in the proportion to the standalone selling price of the goods and services. And this standalone selling price, we already know, is the price at which entity would sell a promised goods and services which is separately to a customer. And let's see an example to understand it in detail. Office Solution enter into a contract to transfer a software license, performance installation and software update and technical support for 5 years in exchange for $480,000. They determine that each goods and service is a separate performance obligation. So they sell the license, installation and update and technical support separately also. So each has a directly observable standalone selling price, which is as follows. Software license is $300,000. Installation service is $120,000. Software update is $80,000. Technical support is $100,000. Total is $600,000. And this is how generally we write it down. If you can see, we have show that all these figures are in $1,000. Now how you do the allocation of this transaction price, because your transaction price was $480 for all these services, $480,000. And if you see, the separate selling price is $600,000. So is it like you have given discount? No, this is not actually the case. This was your marketing strategy which leads to that selling. But now you need to allocate that how much in this 480 against the software license, installation service, software update and technical support. So now the slide which is on your screen is showing that allocation of transaction price to the performance obligation is as follows. For the software license, it is the 480 which is the total transaction price, and you allocate on the basis of the price of software, which is 300, the standalone price, over the total, the total price of the whole 4 different performance obligations, which was 600. Similarly, you can calculate for installation services, software update, technical support, and now you can see the software license which standalone price is 300, but in this contract, the software license is worth $240,000. So this is how in the step 4 you can allocate the transaction price, and then you will be done with the measurement. Now moving to the step 5, which is related to revenue recognition. So recognize revenue on the satisfaction of performance obligation. So it says that when to recognize the revenue. We recognize the revenue when the satisfaction of all the performance obligation which was initially committed by the entity is done, and the customer get the control. So now we see what is important with respect to the step 5. It says that revenue recognition or recognize revenue when or as a performance obligation is satisfied by transferring a promised goods and services or an asset to the customer. So an asset is transferred. When to consider that asset has been transferred? This transferring is based on when the customer gained the control of the asset. And the entity must determine whether the performance obligation will be satisfied over the time or at a point in time. So this IFRS 15 has given a framework that the performance obligation can be identified or satisfied in two ways. Either it can be satisfied over time, and it can be satisfied at a point of time. So we'll see now that how we identify whether a performance has been satisfied over time and at a point of time. So satisfy over a time is referring to a performance obligation is satisfied over time if one of the following if one of the following criteria is met. So in case the customer who received and consumed the benefit of entity performance as the entity performed. So this is over the time because the customer receives and consume the benefits of the entity as an entity performs. So for example, you people are taking the services of attending these sessions. So you are consuming by taking these sessions. So this is the consumption by you, or you are receiving the services when the entity is performing. Similarly, whenever the telephone bills, that we use telephones and we made a call, but for which the payment is made in the next month or maybe by end of this month. So we are consuming the services every day, but for which the performance obligation in this case is satisfied when the entity is performing or the customer is consuming. Another aspect of satisfy over the time or example is when entity performance create or enhance an asset, then the customer control as an asset is created or enhanced.